Could you describe the investment methodology of the M&G Optimal Income Fund?
It's called the Optimal Income Fund because we buy securities. When we buy them, we try to look at the real value of them, and the value of any security is the income stream you get from the security. That income stream can be broken into two parts. It's one, the credit risk. Are you going to receive this income? And secondly, how long that income will last for. Is it a contract to receive that income for 1 year in a 1-year bond, 5 years in a 5-year bond, 10 years in a 10-year bond? So we try to buy the best income stream. When you buy any asset, whether it be an equity, whether it be a bond or it be a property, its value is a function of the income it will produce, and that's what we try to do with the Optimal Income Fund.
Where do you find the best opportunities in the fixed income universe?
We take those income streams and we try to buy the duration in the market we like, and we buy the credit in the market that we like. We don't have to behave like a traditional bond fund where both the duration and the credit are stapled together. So at the moment we think index-linked bonds in the UK are a good duration view. They benefit from inflation being high in the UK as the Bank of England pursues a very easy monetary policy. Yet the credit risk we want to have isn't in the UK. The credit risk we want is US credit. We think the US economy is very healthy, so we have a bias to owning US companies and US credit. So we take a geographical bias to taking credit risk in strong economies, and we'll a bias to buy duration risk in weak economies.
For the equity part of your portfolio, what kind of stock you pick?
I think that the US economy has been through a big boom when the housing market boomed from 2000 to 2007, and it went through an enormous bust from 2007 to 2010. When you look at the US housing market now, it's had its inventory correction, it's a lot healthier. And the big swing factors of US GDP growth which affect US companies are construction and car sales. Construction is at such a low level it can only pick up. Car sales are at such a low level they can only pick up. So it's very, very hard for the US to go into recession.
Could you describe the 4 steps of your investment process?
The recovery investment process could be split into 4 stages. Stage 1 is when we first make an investment in the company when it's unloved. The company then starts to make changes, starts to implement a new strategy, and this period is what we call stage 2, where the company is stabilising. By the time the company's in stage 3, it's recovering well.